Welcome back to Investing Talk podcast. Today we're looking into a company you brought to our attention, USA Rare Earth. We've gathered quite a bit of material to try and get a handle on this one, and if you find these kinds of explorations helpful, do take a moment to subscribe, like the show, maybe leave a comment. It really helps us keep doing this.
Absolutely. And this company, USA Rare Earth, it sits right in a really critical space. We're talking rare earth magnets, critical minerals, that whole ecosystem.
Mm-hmm. So our goal today is to unpack all this information we have, figure out their business, what the financials look like, recent moves they've made, and, what the future might hold, especially regarding that big push for a domestic supply chain here in the U.S.
Yeah, and there's a definite tension here, isn't there? I mean, the sector itself is incredibly important, high potential. But the information we've reviewed suggests the company is, well, pretty early stage, and it
Yeah.
flags some pretty significant risks, too.
That's what makes it interesting, though, right? So why should you care about this? Well, understanding a player like USA Rare Earth gives you a window into the challenges, the opportunities in a market that's just fundamental for technology, for defense, for energy independence.
It really goes beyond just one company. It's about, like, the future infrastructure.
Okay, so let's start with the basics. What is USA Rare Earth trying to do? What's their core business model based on what we've seen?
Well, they're ambitious. The plan covers quite a few bases in the rare earth value chain.
Right, it's not just one thing. It looks like they're aiming for magnet manufacturing, metal making, processing the raw materials, even potentially mining. It's a wide scope.
And that scope ties directly into their big strategic objective, becoming a key Western supplier. And, crucially, establishing that whole domestic supply chain for rare earths, right here.
Which is a huge undertaking. We're talking about materials needed for, well, everything. Electric vehicle motors, defense systems, wind turbines, even parts of your phone.
Exactly. The applications are critical. That's why there's such a push, from governments, from industry, to reduce reliance on the current dominant suppliers. Building that independent chain, that seems to be their central mission.
So turning to recent events, the material mentions they started trading on the Nasdaq, ticker USR, earlier this year, 2025, after a merger.
And there have been some specific concrete steps lately highlighted in the information. A big one seems to be a reported $75 million PIPE investment.
Okay, a PIPE. Private investment and public equity. So selling stock directly to investors, not on the open market. And that money, the $75 million, is specifically for their magnet facility in Stillwater, Oklahoma.
That's what's indicated, which is significant, right? It's funding a very tangible piece of their strategy, the manufacturing part.
It suggests some investor confidence in that specific build-out.
It does. And tied to that, there are personnel moves mentioned, like appointing David Bucci as SVP of manufacturing back in early June, bringing someone in for that role. It really underlines how critical getting that factory operational is right now.
Makes sense. And in this industry, partnerships are often key. There's mention of an MOU with Polar Star Innovations signed in late May.
Yes, that collaboration is focused on U.S.-made Indy Fe-B magnets, neodymium iron boron, the really strong ones. And the stated goal, again, is building that domestic supply for critical industries, defense, but also consumer goods. It shows them actively, trying to link up with others to make this happen.
Okay, now let's pivot to the financials. The Q1 2025 results reported mid-May. This is where we need to look closely at the details provided.
Well, the first thing noted is an operating loss of about $8.7 million for the quarter.
An operating loss. I mean, that's maybe not shocking for a company spending heavily to build things, right? Facilities, R&D, hiring people,
Right.
Before they're really selling much.
That fits the picture of a company in investment mode. But then there's this other number, a reported net income of $51.8 million for the same period.
Whoa, okay, that looks huge. Compared to an $8.7 million operating loss, how does that work?
Well, the explanation provided is pretty clear, that net income was mostly driven by non-cash warrant gains.
Ah, okay, non-cash warrant gains. Let's unpack that because it's important. Warrants give someone the right to buy stock later at a set price, a non-cash gain on warrants. That often means the value of those warrants on the company's books went up, maybe due to stock price changes or accounting rules.
That's the idea. It's an accounting adjustment reflecting the changing value of those financial instruments. It's not cash coming in the door from making or selling magnets or their core business.
That distinction is critical. So the headline, net income looks good, maybe grabs attention, But the operating loss, that $8.7 million, probably gives a clearer view of how the actual business operations performed. They spent more than they earned running the core activities.
And the context provided aligns with that heavy investment in building out this domestic supply chain infrastructure. That costs money up front.
Makes sense. So they're in that build-out phase. What about the stock price reaction to that Q1 report? Did it react to the headline number?
It seems there was an initial jump, yeah. Up about 5.5% right after the announcement.
Maybe reflecting that net income figure or the funding news?
Could be. But it's also noted there was significant volatility just before that report. The stock was down something like 11% the week prior.
So a pop on the news, but within a pretty choppy environment. Okay, let's try to get a broader financial picture, sticking just to the information available.
What really jumps out is, well, what's not there? A lot of the standard metrics you'd look for in a mature company aren't really applicable or available yet.
Right, like consistent revenue figures or a clear growth trend. It's acknowledged their early stage, focused on funding and hitting milestones, not generating big sales yet.
And without consistent operating profits, things like EPS earnings per share or the PE ratio, they're either not meaningful or just hard to calculate reliably at this point.
Same goes for other ratios mentioned, like debt to equity, return on equity, price to book, these tools that help assess leverage, profitability, valuation. The data just doesn't seem to be there yet in a useful way.
What is mentioned on the cash flow side is a net increase in cash of about $1,600 in Q1 2025, which is described as positive cash flow generation for that quarter.
It's interesting. Positive cash flow in a quarter with an operating loss, though historical data isn't readily available to see if that's typical, could be tied to the funding coming in.
It points to how crucial raising capital is for their cash position right now, maybe more so than operations. And related to capital, it's confirmed they don't seem to be paying dividends, which is totally normal for a company focused on growth and reinvesting everything.
And while there's no specific beta figure given for volatility, we already heard about those price swings, suggests it's likely a volatile stock.
So summing up the financial view from the information we have, it's really dominated by that early stage reality. Heavy reliance on raising funds. Traditional metrics don't tell the whole story yet. It's about funding the plan and hitting those operational targets.
Okay, so let's talk strengths and risks as laid out in the material. What are the key positives highlighted?
Well, first off, their success in raising money. That $75 million PIPE is significant, and apparently they've pulled in over $100 million total since the start of 2025. That shows someone believes in the plan enough to put serious money down.
That's definitely a strength. What about on the technical side?
There's mention of progress making high-purity dysprosium oxide. That's a critical, heavy rare earth. And also getting their innovations lab up and running. Steps toward proving they can actually do the technical stuff.
And the partnerships, like with Polarstar.
Definitely a positive. Collaborating can speed things up, share costs, maybe lock in future customers or sales.
And then there's the core strategy itself, the domestic focus.
You could argue that's their biggest potential strength. In today's world, with all the concern about supply chains, geopolitics, having a U.S.-based source for these critical materials is a potentially huge advantage if they can execute. It tackles those dependency worries head on.
There are also some pretty serious red flags and risks mentioned. What stands out there?
The biggest one seems to be that reliance on external funding. Building all this, it costs a fortune. The information flags the risk if future investments don't materialize. They need that cash to keep going with the plan.
And connected to that, there was one specific phrase that really jumped out.
Yes, the mention of substantial doubts about continuing as a going concern.
And for you listening, when you see that phrase, it's a formal flag. It means there's recognized uncertainty about whether the company can keep operating without raising significant more capital. It signals financial precariousness.
It really underlines that the need for capital isn't just for growth, it might be for survival. And beyond those company-specific money worries, there are the broader industry risks.
Like the geopolitics and supply chain issues inherent in rare earths.
Definitely. Where mining and processing happen now, it's concentrated. So shifts in international relations, trade policies, those can have massive impacts.
Regulatory changes too, like tariffs.
Could affect their costs, their competitiveness. Then there's market risk demand for EVs, wind turbines, it fluctuates. And just the overall economy. Interest rates impact funding costs, economic health impacts demand, lots of external factors.
So how do they fit into the competitive landscape based on this info?
Established players are mentioned, like MP Materials, Lynas Rare Earths. The picture painted is that USA Rare Earth is kind of the challenger right now. trying to carve out a niche by building that fully integrated mine-to-magnet domestic chain, which is different from what some others are doing.
Looking forward then, what are the next big things to watch for? Any specific milestones coming up?
The main ones identified are completing that magnet factory in Oklahoma and then hitting their target to actually start producing sintered magnets there in 2026.
Okay, those would be huge steps, moving from planning and funding to actually making things.
Crucial proof points, really, for judging if they can actually deliver on this ambitious strategy and start generating real revenue from manufacturing.
All right, let's try to pull this all together. Based on everything we've looked at, what's the overall snapshot of USA Rare Earth right now?
You've got a company with a really important strategic mission, operating in a sector everyone agrees is critical. They've shown they can attract significant funding, and they seem to be making real progress on the ground, building facilities, hitting technical steps.
But, and it's a big but, they're facing major financial hurdles and all those industry risks we talked about.
That's the crux of it. They're early stage, meaning that dependency on ongoing funding is intense. The information is quite clear about the financial uncertainties, including that really significant going concern language. That's vital context.
And the industry itself just comes with a lot of volatility, geopolitical, supply chain, market swings, stuff they can't fully control.
So the general sense we get from the analysis points towards maybe a hold or perhaps a buy, only for very long-term investors who specifically want exposure to this sector, understand the high risks involved, and are prepared to watch very, very closely.
Right. It's an outlook that acknowledges the potential upside tied to their strategic goal, but tempers it with realism about the huge execution risks and financial fragility involved in building this kind of operation from the ground up. It really puts the onus on you, the listener, to track their progress closely, not just react to headlines.
Monitoring is key.
So stepping back, the core tension is stark, isn't it? You have this undeniable national need, this technological imperative for a secure domestic rare earth supply chain, exactly what USA Rare Earth aims to provide. But the path to achieving that is paved with massive investment needs and incredibly high financial risks for the companies trying to blaze that trail.
And that financial piece, understanding how they can report a big net income figure that's mostly counting gains while still losing money on operations because they're investing so heavily, that's a key insight. You really have to look under the hood.
It shows that hitting milestones, raising money, that's positive movement, but it doesn't automatically equate to financial stability yet. They could still be walking a tightrope, needing constant funding injections just to keep building.
It's definitely a complex situation.
Which leaves us with a pretty big question to chew on. Given how strategically vital rare earths are, how do we balance that national importance against the very real, very significant financial risks these pioneering companies like USA Rare Earth are taking on? Is the market opportunity for U.S.-made rare earths ultimately big enough, stable enough to overcome the immense capital required and navigate the turbulent geopolitical waters of this industry?
That's the multi-billion-dollar question, isn't it? For the market, for policymakers, and for anyone invested in this critical sector.